Welcome to the Tons of Industry Show. I'm very excited to be speaking to a great newsletter writer today. His website is thegartmanletter.com, and leading banks, brokerage firms, hedge funds, mutual funds, and energy and grain trading firms from all around the world are reading it daily for many, many decades. He's featured on CNBC regularly, and I'm thrilled he could make the time to share with us his analysis. Dennis Gartman doesn't need any introduction. Dennis, how are you today?
I'm doing fine this morning. Thanks for having me on. My honor.
Dennis, let's talk about commodities and more about the actual fundamentals, supply and demand, and less about timing and technical analysis. So first of all, with energy, oil has been down or at $60 for years. Technology has made it available to us at these levels. I have three questions for you. One, is the U.S. an oil exporting empire in the coming decades? Two, are other forms of energy, such as uranium, natural gas, or renewables, likely to meaningfully change oil dominance, or are we still living in an oil-dominated world for decades to come? And three, will oil trade above $100, possibly more, anytime in the near future?
Let's take the last question first, and the answer is a definitive no. No, oil will not trade above $100 in the near future. Perhaps 15, 20, 30 years, 40 years, 50 years into the future, it may. I have my doubts. But there is so much crude oil that is being found, so much new technology being brought to bear, that I think the odds of crude oil ever getting back above $75 to $80 an ounce or per barrel are relatively minimal. I just don't see that. What we have to understand is that fracking has changed the world, and I guess this gets to question number one. Fracking has really changed the world. The technologies involved, the ability to drill more efficiently, more effectively, have just changed so dramatically in the course of the last 20 years. For example, 20 years ago, our drill rates, if you drilled a well, it was probably a 50-50 chance that you would hit crude oil. Now, with seismic technologies, with better computer technologies, with better understanding of geology, with further understanding of how the rock structures exist, our hit rates are approaching 95%. We don't drill unless we hit a well anymore. That's just an amazing shift in sentiment. There's no such thing as a wildcatter any longer. These are now real businessmen drilling real wells into real arenas using real technologies to find real amounts of crude oil and natural gas in areas that they didn't think existed a mere 10 years ago. Two, the change that has occurred in the ability to drill. In the past, you drilled, I used to refer to a drilling rig as a soda straw. You stuck the soda straw down into the ground. You hoped you hit crude oil. Now, and we used to think that crude oil and natural gas deposits were rather finitely shaped, rather definitively shaped. Now we understand that they actually look like your fingers on a hand spreading miles underground. And in days a mere 10 years ago, you hoped you hit the palm of that hand. Now you can send a soda straw down, bend it, and drill for crude oil, natural gas into the fingers that a mere few years ago were utterly impossible to get to and wholly unprofitable to have gotten to. Now we can get to them, and now we can get to them in a profitable circumstance. So that alone has changed. Is the United States an exporter of crude oil? Not yet. Is the United States an exporter of energy generally? Absolutely it is. And that is a material change over the course of the last mere 5 or 10 years. Now we have an abundance of natural gas. We have an abundance of crude oil. We have an abundance of the ability to export products, gasoline and distillate. So we are actually an exporter of products. We still are prohibited in many instances legally from exporting crude oil, but we can export products. There is no legal proscription against doing so, and we are actually doing precisely that, and that's going to continue. Finally, what we really need to understand is we're the only nation that is practically and abundantly fracking for crude. Now, do you really think that the Russians will not be fracking? They've actually fracked their first well in Siberia about 3 months ago, and it's been successful. There will be hundreds of fracked wells in Siberia in another 15 years. The Saudis have never fracked a well. Believe me, the Saudis will be fracking wells all across the desert. In Africa, in Angola, and Nigeria, they have not fracked any wells yet. Believe me, they will begin fracking in abundance in Nigeria and Angola in the coming years. They are actually beginning to frack in England, of all places. So, and China has not fracked a single well, to the best of my knowledge. Believe me, they will be fracking wells everywhere in China in the not-too-distant future. They are all importing our technology. We may not like that, but that's just the harsh reality of the circumstance that prevails today. They have learned from us on how to frack better and better. We've learned how to use better chemicals. We've learned how to use better sand. We've learned how to twist the wells more efficiently. We've learned how to use seismic technologies more efficiently. The game of energy has changed dramatically. So to get back to question number 3, is crude oil going to get back to $100 anytime soon? There's no chance. That's my story. I'm sticking with it.
With only 400 uranium employees in the U.S. industry domestically, 95% of uranium is imported, and many people see this as a national security hazard because 21% of Americans, which is around 60 million people, receive their energy and electricity using nuclear power.
I am not as fearful about that sort of thing as the news media would have us believe. I'm a great proponent of nuclear fission and hopefully eventually nuclear fusion, something that will be extant 15, 20, 30 years into the future, where that will be the great supplier of energy to if I ever have grandchildren, or to my great-grandchildren, if that ever occurs. Fusion will be the ultimate, without a question, the ultimate source of energy, and it will be the reason why crude oil prices will eventually move to zero. It'll be the reason why natural gas prices will eventually move to zero, but that's decades into the future. And I am dismayed by the fact that we have not in the United States built a new nuclear fission electricity generating plant in the last 30 years. That's silly. I'm very dismayed by the fact that the Japanese have moved away from nuclear power. It is the cleanest, most efficient source of energy available to us right now, and we should be using it. But do I fear the problems that are making the front pages in the newspaper concerning the exports of uranium to the Russians or whoever is getting it? No, I'm not that fearful about that whatsoever. Others might be. Perhaps I'm naive about it, but I'm not too concerned. For the foreseeable future, carbon fuels, natural gas, crude oil predominantly, is going to remain the world's predominant fireable energy source. I wish nuclear were far more efficient than it is. Eventually, and we are learning how to drive the cost of solar energy production facilities down dramatically over the course of the past decade. But even that, don't hold me to the data, but I think less than 0.2% of the world's energy comes from solar energy. Maybe that'll rise. Maybe that'll go up tenfold and get to 2 or 3% in the course of the next decades. But is anything like that going to usurp crude oil in the next 10 years? I doubt it. The only thing that shall really usurp it eventually shall be nuclear fission and ultimately nuclear fusion. Now remember, nuclear fusion does not require uranium.
Dennis, let's discuss China, India, and the developing world. They are consuming plenty of zinc and copper. Prices are rising, but zinc and copper small cap stocks are lagging. My question to you is this: with no major zinc discoveries for almost 20 years, and with a copper demand exploding right now, why are investors choosing to go with ETFs? Has this become the permanent choice for commodity investors instead of finding particular companies that have more potential? They're going for a more broad approach of just buying an ETF and going long.
Well, to be quite honest, if I'm going to invest in copper, I don't have the time to ascertain which copper company is better, which copper company has the better facilities, which one has the better mining capabilities, which one has the better financial wherewithal. I don't have that time. I have to watch what's going on in the corn market. I have to watch what's going on with the Federal Reserve. I have to watch what's going on in foreign exchange. I have to watch what's going on in energy prices. I have to watch what's going on in live cattle. I have the time, nor have most investors the time, to look at specific copper companies, specific zinc miners, specific tin miners, And I think that ETFs actually do a reasonably good job, because if you're running an ETF that is copper-oriented, your job solely is to understand which copper company is best, and perhaps you will do a better job of picking those copper companies. So I'm not as antagonistic towards the idea of ETFs as a methodology for investment as the question would seem to indicate. What I do think is that's happening is that copper prices probably are still going to go higher because of the advent and the continued expansion of electrical cars. They still, electricity generation still requires more and more copper. I mean, it's just that simple, and one needn't get more esoteric than that. And you're going to see an ever-increasing number of electrical cars, especially in third world countries, or especially in less developed countries, and especially in China. And that's the major derivative, the major sponsoring agent for higher prices of copper. Is that going to end anytime soon? I doubt it. And so I think it's reasonable to be a buyer of copper. I think it's the wise thing to be a buyer of copper. And I think that whether you create your own ETF by buying a series or a number of various copper mining companies, or if you buy copper futures, or if you buy copper ETFs, I think you'll do yourself well. So I'm not as deleterious, as detrimental to copper as a communal trade as the question might seem to indicate. I think you simply want to err upon the side of owning copper generally. However, whatever manner you affect that trade, I think in the course of the next 2, 3, 4, 5 years, you'll do fine. Thank you very much.
With regards to silver, first of all, historically it has been mostly used as a precious metal for monetary uses. Since 1971, that aspect of it is largely gone, with the exception of a small community that still sees the same qualities in it as it does in gold, save for the part that the mining ratio is 9-1. So they feel that if gold and silver perform the same functions as money, as monetary metals, then silver should possibly be trading at over $100 using this mining ratio. But in actuality, banks, governments, and institutions do not choose to buy silver. Rather, they stick to only gold. So silver has become mostly an industrial metal. It has thousands of uses right now, and it's in a supply deficit. And my question to you is this: is this one of the greatest speculative opportunities in commodities right now? The apparent disconnection between the precious metal and the premium that silver should have as a precious metal, and the fact that it's trading just above its production price because it's mostly used as an industrial metal.
Well, I mean, your question is trying to force me into saying yes. I will simply say that with the gold-silver ratio at 75-1, one of the hallmarks of a bull market in precious metals generally, if you throw palladium, platinum, gold, and silver into one stew and swirl it together, one of the hallmarks of a bull market in the precious metals is that the gold-silver ratio falls. And 75-1 is to me a very high level of price of gold relative to silver. What seems more reasonable? What seems more rational? Can we get the gold-silver ratio to trade under 50? Over the course of the next decade or so, almost certainly we shall. I think it is important to note that in the past several weeks, the past several months, the gold-silver ratio has actually broken below 75. It's held that number for a couple of weeks. But if we break under 75, I think that will be an important precursor for a bull market in precious metals generally. Keep an eye on the gold-silver ratio. However, do I think that silver is going to $100? No, not in my lifetime. Do I think that the gold-silver ratio can trade to 50 or lower? Yes, almost certainly. Do I want to put the trade on my own? No, not particularly so at this point. But for those people who want to trade the precious metals in a collective form, keep an eye on the GSR. If it trades down under 75, if it trades to 74, for example, that will be a technical signal that the bull market in precious metals generally is upon us, and that prices on balance shall rise. I think that's the most important thing to take away.
Okay. By the way, when that happens, usually the stocks outperform both the metals when the silver ratio, when the silver to gold ratio.
That's a hallmark of a bull market in the precious metals when the metals stocks perform better than bullion itself does. And for the past several weeks, we're here talking on October 20, what's today, October 24th. For the past several weeks, that has not happened, and that's dismayed me a little bit, the fact that the mining shares have underperformed bullion. One of the hallmarks, another hallmark of a bull market in bullion is that the mining stocks outperform bullion, and they haven't done that recently. That's a bit disconcerting to me.
With gold covering a mere 8% of global credit, many argue that using this fact alone, in order to resume to a more reasonable 20% coverage, the price would essentially have to be 2.5 times higher, thus $3,200 per ounce, or at 40% of the credit supply, $6,400 per ounce. Moreover, 8% is very low. It's the lowest it's been since we went off the gold standard, and the ratio with the S&P 500 has dwindled down to about 2 ounces of gold for 1 point of the index, also a critical low. Before asking my question, I'd like to throw in my view of this, Dennis. Speaking with many influential investors over the past 3 months, they're sitting on large gains. They believe that the U.S. equities indices have more room to go higher, and so they're not emotionally ready to take profits yet. Instead, they rather hedge any correction by buying gold stocks right now. And this is what I think is going to happen in the next few months. What are your thoughts on this? Are you seeing the rubber meet the road here and this trend reversing?
I could not argue even slightly if I wanted to. I think that's exactly correct. I think the relationship of gold relative to stock prices is preposterously, stunningly, shockingly, overwhelmingly, ludicrously, comically low. I am the chairman of one university's investment division, and I've made the actual movement. We've moved in the course of the past several months to reduce our exposure to equities and to increase our exposure to real assets, by predominantly reducing our exposure, and still we are overwhelmingly long of stocks. Let's not misconstrue this. But we've reduced our exposure to stocks and increased our exposure to gold primarily for that precise reason. The relationship between the two has gotten to levels that I think are preposterous in orientation. And probably over the course of the next decade or two will shift dramatically. Is gold cheap? Yes, I think gold is relatively cheap. Gold is cheap relative to stocks. Gold is cheap relative to bonds. Gold is cheap relative to crude oil. Gold is cheap relative to almost any other commodity, save perhaps the grains. So I tend to agree with you on this concept entirely. I think if one is an investor and has 100% of their position, perhaps it is bringing it down to 8% and precious metals. I think that answers the question.
Let's talk about inflation, if you don't mind. What the past 8 years have proven is that excess capital and excess credit does not usher in inflation instantly and directly when it's mostly going to the hands of the rich. They do not need much spending like the middle class or the lower classes do. Thus, it looks like the central banks, in order to stimulate the economy and create more inflation, will need to find ways to inject credit directly into the hands of these people. Either that, or the government will need to do it instead of the central banks. The other choice facing the U.S. is exporting all of this excess capital, excess dollars, and fueling a credit boom in developing nations, making them stronger at the expense of the U.S. No easy fix here, but obviously inflation is a huge problem. Do you see a double-digit inflation environment soon, or do you see further deleveraging and perhaps even deflation? Shouldn't investors be willing to face both inflation and deflation in case the central banks or the governments cannot change the financial behavior of the public?
I think that I begin by saying that I'm still a relatively doctrinaire monetarist. I believe that that inflation always and everywhere is a product of excess supply of reserves to the system by the monetary authorities. And clearly there has been a dysfunction, a disengagement, a problem with that theory in the course of the last decade, for lack of a better term. Because the monetary authorities have all experimented with quantitative easing. I prefer to use the old term monetization, The monetary authorities in the Bank of Japan, at the Fed, at the ECB, at the Bank of Canada, everywhere around the world have been aggressively expanding the supply of reserves, buying Treasury securities, buying Bank of Canada securities, buying JGBs in Japan, buying the debt of the various 27 nations involved in the European Union, and yet inflation has been, for all intents and purposes, by statistical analysis, existent. Now, those of us who have children that are going to college know there's inflation. Those of us who have health problems know there's inflation. Those of us who bought a house in the course of the last 5 years know there's inflation. So the statistics, I think, are somewhat specious. I think there's a greater amount of inflation out there than the monetary authorities, than the statistical keepers of the truth would leave us to believe. There clearly is rising prices in many, many areas, but there has not been an expansion of inflation as far as wages are concerned, and therein lies the problem. I think that is about to become an old problem. I think that wages are about to start to go dramatically higher over the course of the next several years, and I think inflationary pressures are likely to become far more evident to almost any discerning eye. The Fed wants to see inflation above 2%. I think inflation is probably closer to 3 or 4% if properly measured, and I wouldn't be surprised if in the next 10 years we see inflation at 5 or 6%, just because of the expansion of the reserves by all the monetary authorities has continued. There has been talk that they will slow that supply of reserves. That's just talk. That's no action thus far. So I think clearly inflationary problems will be far more evident in the course of the coming several years. Supportive of gold prices, probably detrimental to equities prices, and certainly quite detrimental to bond values.
A big question for you, Dennis. Do you fear any system collapse? I mean, you've seen everything.
No, I do not. I do not fear a system collapse. I've only been in the business for 45 years, so I'm relatively new at it. But beginning in the first 2 years of being in the business of trading, I heard about the coming collapse. 35 years ago, I heard about the coming collapse. 25 years ago, I heard about the coming collapse. 15 years ago, I heard about the coming collapse. 5 years ago, I heard about the coming collapse. I hear about the coming collapse today. 5 years from now, I will hear about the coming collapse. 15 years from now, I will hear about the coming collapse. 25 years from now, I will hear about the coming collapse. It is nonsense. I do not fear a coming collapse.
Dennis, just to clarify, when I'm speaking about a system collapse, I'm referring to the inability of political and monetary institutions to find a solution to the debt load overhanging all Western nations in a way that doesn't disrupt and doesn't destroy vast amount of equity held by people who today trust their governments to stay stable.
As a student of history, all societies eventually go by the wayside. Rome no longer exists. Greece no longer exists. The Byzantine Empire no longer exists. The Ottoman Empire no longer exists. The Mongol Empire no longer exists. All great empires go the way of all flesh eventually. Our system is only 200 years old. Those systems lasted for hundreds upon thousands of years. We're young. We'll continue to be around for a long period of time. Betting on the demise of the United States as a viable economic and political and military power is a very, very, very poor bet. I would not make that bet.
How do you view the supply demand of cobalt or lithium, if you have any opinion on this?
You know what? I've been taught that when something is beyond your pay grade, tell people that's beyond my pay grade. That's outside my ken. I will leave that to others wiser than I.
What's the most compelling opportunity right now as you see it with regards to commodities?
I think that owning grain is probably as good an idea as you're going to come across at this point. I could be wrong, but grain prices are down dramatically over the course of the past year and a half. We are an amazing producer of grain here in the United States, but there are some other problems that might be kicking in down in South America. If you made me only choose one thing to be long of, let me be long of corn at this point. Let me be long of wheat at this point. Let me be long of soybeans at this point. If I could only choose one thing to be long of, but I wouldn't want to see it move more than 3, 4, 5% against me. At the same time, I can imagine corn and wheat prices moving 15 and 20 and 25% higher. I think the risk reward is 5 to 1. I think the odds of success are at least 65-35 in your favor.
Dennis, has any commodity peaked in production in your estimate, or peaked in price?
Not that I'm aware of. Not really. I suppose there are some smaller vacuous commodity prices or commodities of which I'm not aware, but no, I don't think that anything has peaked at this point. Maybe livestock prices, but the operative word here is maybe in all capital letters.
No, not peaked in price, peaked in production.
No, not really. I don't think so. I think crude oil, natural gas production is going to continue. I think grain production is likely to continue. 5 years from now, we will produce more grain per acre than we're producing now. I think we'll produce more copper 5 years from now than we're producing now. I bet we produce more gold than we will be producing now. And I bet the population of the world will be larger than it is now, and the demand will probably increase from population increases consistent with the increase in production of most commodities. So the answer is no, I don't think any commodity has reached its peak in production. However, can I be wrong? Yes. Are there people wiser in each of the individual commodities than I shall ever dream of being, who can make the case otherwise? Excuse me, obviously. But in generally, do I think that we've seen that? No, I do not.
Where can people check out more of your work, Dennis?
Well, I've been writing the daily commentary, the Gartman letter, for 35 years, and I'm proud to say I've never missed a day in 35 years. I produce it every single Monday through Friday, with the exception of Christmas and New Year's, which are the only real international holidays. I haven't missed a day in 35 years. They can they can send an email to Chip, C-H-I-P, Chip at thegartmanletter.com, TheGartmanletter, and ask to be put on trial. Or they can go to the website, thegartmanletter.com, and take a look. It is institutional in nature. I've been at it for 35 years, and I hope I can be at it for another 35 more, although I'll bet the under.
Dennis, thanks for coming on the show. It was my pleasure.
Thank you for having me. It's been my honor. The questions were wonderful, and I appreciate your time. Good luck. And as I sign off every day in my newsletter, good trading.
A critical point Mr. Dennis Gartman has raised on our interview today is that investors don't have the time to research for specific mining companies. Therefore, they're going long through a mutual fund or a futures contract or an ETF, and that's the way that they go right now. This is one sign that the bull market in commodities hasn't started yet, because as you can see with cryptocurrencies, there are no ETFs, and investors spend days and weeks reading white papers and researching specific opportunities and ICOs. It's all a matter of willingness to invest the time and willing to pay the price to see staggering gains. It's a matter of focus. If investors aren't focusing on commodities, the interest in research subsides, and this plays right into the hands of investors with top quality companies in mind, such as Gold Mining Inc., run by Amir Adnani, or First Mining Finance, run by Keith Neumeier, where right now open market interest is low and shares are cheap, though these companies are far superior to their competitors as I see it. Another critical point in is the trust that Dennis has in the free enterprise system and in human ability to correct malinvestment by governments or central banks. Yes, we've had problems like this before, and yes, there will be problems in the future. There will be recessions. There will be market crashes. But it's all about being prepared and not being afraid. Go to wealthresearchgroup.com and educate yourself on finance, and using our wide array of special reports, become a more astute investor. Thank you for joining us today.